Something unprecedented is happening in the silver market right now, and if you're not paying attention, you're about to miss one of the most explosive moves in precious metals history. Silver just broke through a technical barrier that's held it captive for over 4 decades. We're not talking about some minor resistance level. We're talking about a generational breakout that signals the beginning of a bull market that could dwarf everything we've seen before. Let me show you exactly what's happening, why this changes everything, and what it means for your wealth in the months ahead. Right now, as I'm recording this, silver is trading around $64 per ounce. That's a 120% gain in a single year. But here's what most people don't understand. This isn't just a rally. This is the early stage of a structural shift that's been building for years. The metal opened the year below $29. 12 months later, it's more than doubled. And according to multiple technical analysts, this is just the beginning. Some are calling for silver to hit $100 per ounce. Others are going even further, suggesting we could see prices in the hundreds. Now, I know what you're thinking. That sounds insane. How could silver possibly reach those levels? Let me walk you through exactly why this isn't just hype. It's mathematics. First, let's talk about what just happened technically. Silver broke out of a massive cup and handle pattern that's been forming since the early 1980s. For those who don't follow technical analysis, a cup and handle is one of the most reliable bullish patterns in trading. It represents a long period of consolidation followed by a breakout that typically leads to explosive upside moves. But this isn't just any cup and handle. This pattern has been developing for over 40 years. The last time silver was at these levels and breaking out like this was in 1980, when the Hunt brothers tried to corner the market and silver briefly touched $50 per ounce before crashing. What's different this time? Everything. In 1980, the silver rally was driven by speculation and market manipulation. It was artificial. It couldn't last. This time, the move is being driven by something far more powerful: fundamental supply and demand imbalances that cannot be fixed. Let me explain what I mean. Silver is facing its 5th consecutive year of supply deficits. That means for 5 straight years, the world has consumed more silver than it's produced. The deficit for this year alone is projected to be over 300 million ounces. Think about that for a second. 300 million ounces of silver that the market needs simply doesn't exist. And this isn't a temporary problem. It's structural. Why? Because silver isn't just a monetary metal anymore. It's become absolutely critical to the technologies that are supposed to save our planet and power our future. Solar panels require silver. Every single one. The photovoltaic cells that convert sunlight into electricity need silver because it's the most conductive metal on Earth. As the world races to build out renewable energy infrastructure, silver demand from the solar industry has exploded. Electric vehicles need silver. The average EV uses about twice as much silver as a traditional car. With governments around the world mandating the phase-out of internal combustion engines, EV production is skyrocketing, and every single one of those vehicles needs silver. 5G networks need silver. The infrastructure build-out for next-generation wireless technology requires massive amounts of silver for the electronics and circuitry. As countries compete to dominate the 5G landscape, silver demand continues to climb. Medical devices need silver. Its antibacterial properties make it essential for everything from wound dressings to surgical instruments. As healthcare advances and populations age, medical silver demand keeps growing. And here's the kicker. Unlike gold, most silver gets consumed. When you use silver in a solar panel or an electronic device, it's gone. You can't easily recover it. Gold gets hoarded and recycled. Silver gets used up and disappears. So you have this perfect storm developing. Industrial demand is surging across multiple sectors. Supply is constrained because silver is primarily a byproduct of other mining operations. You can't just decide to mine more silver when prices go up, and above-ground inventories are being depleted year after year. The Silver Institute is forecasting that global automotive silver demand alone will increase at a compound annual growth rate of 3.4% between now and 2031. That's just one sector. Add in solar, 5G, medical, and all the other industrial applications, and you start to see why this supply deficit isn't going away. But there's another layer to this story that most people are completely missing, and it has to do with what's happening in the financial system right now. Central banks around the world are buying gold at record levels. They're diversifying away from dollar reserves. They're preparing for a monetary system that looks very different from the one we've had for the past 50 years. And while they're focused on gold, the smart money is watching what happens to silver. Historically, silver has always been gold's more volatile little brother. When gold moves, silver moves harder. The gold-to-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, has been a key indicator for precious metals investors for centuries. Right now, that ratio is still elevated compared to historical norms. If silver were to return to its historical relationship with gold, we'd be looking at significantly higher silver prices, even if gold just stays where it is. And gold isn't staying where it is. Gold is also in a bull market, driven by the same forces of monetary instability and geopolitical tension. Let me paint you a picture of what's really happening behind the scenes. The COMEX, the commodities exchange where silver futures are traded, has been showing some very interesting patterns lately. Open interest has been climbing while registered inventory has been falling. That's a setup for a potential short squeeze. What does that mean in plain English? It means there are a lot of paper contracts betting on silver prices, but there's not enough physical silver to actually deliver if those contracts get called. It's a game of musical chairs, and there aren't enough chairs. We've seen this movie before. In 2021, retail investors on Reddit tried to squeeze silver by buying physical metal and draining dealer inventories. They called it the silver squeeze. It caused temporary disruptions and price spikes, but ultimately the move fizzled because the broader market conditions weren't right. This time is different. This time, it's not just retail investors. It's industrial users scrambling to secure supply. It's institutional investors recognizing the fundamental story. It's countries looking to diversify their reserves. The pressure is coming from all directions at once. And here's something that should terrify anyone who's short silver or betting against this move. The market structure has changed. The big commercial banks that used to dominate silver trading and keep a lid on prices have been reducing their short positions. Some have even flipped to the long side. When the traditional suppressors of silver prices start positioning for higher prices, you know something fundamental has shifted. Now let me take a quick detour here because this is important. If you're sitting on $100,000 or more in retirement accounts, you need to understand how gold IRAs work. I put together a free guide that covers exactly how to get physical precious metals into your retirement account without triggering tax penalties. It's in the description below. This isn't about trading or speculation. It's about wealth preservation and making sure your retirement savings maintain their purchasing power in an environment where currencies are being debased. Worth checking out if that's relevant to your situation. All right, back to what's happening with silver right now and where this is headed next. Let's talk about the historical parallels, because understanding the past gives us a roadmap for the future. In 1971, President Nixon closed the gold window and ended the dollar's convertibility to gold. That kicked off a decade-long bull market in precious metals that saw gold go from $35 to over $800, and silver go from under $2 to $50. The move wasn't linear. There were corrections and consolidations along the way. But the overall trend was unmistakable, driven by inflation, currency debasement, and a loss of confidence in the monetary system. In 2008, the financial crisis triggered another precious metals bull market. Gold went from around $700 to over $1,900 by 2011. Silver went from around $9 to nearly $50 in that same period. Again, the move was driven by monetary expansion, quantitative easing, and fears about the stability of the financial system. Now here we are again. But this time, the monetary expansion has been even more extreme. The debt levels are higher, the geopolitical tensions are more severe, and we have this additional layer of structural supply deficits driven by industrial demand that didn't exist in previous cycles. Some analysts are drawing comparisons to the 1970s, but with a twist. Back then, silver's move was primarily monetary. This time, it's both monetary and industrial. That's a much more powerful combination. Think about what happened with palladium a few years ago. Palladium is used primarily in catalytic converters for cars. When supply couldn't keep up with demand from the auto industry, palladium went from under $500 per ounce to over $3,000 per ounce in just a few years. It more than sextupled because of a structural supply deficit in an industrial metal. Silver has that same industrial demand story, but it also has the monetary demand story. It's both a precious metal and an industrial metal. That dual nature makes it unique, and it's why the potential upside is so significant. Let me give you another way to think about this. The total value of all the silver ever mined and still in existence above ground is estimated to be around $1.4 trillion at current prices. That sounds like a lot until you compare it to other markets. The total value of all gold ever mined is around $15 trillion. The global stock market is worth over $100 trillion. The global bond market is worth over $130 trillion. The global real estate market is worth over $300 trillion. Silver is tiny. It's a rounding error compared to these other asset classes. Now imagine what happens when even a small percentage of capital from these larger markets decides to flow into silver. The price impact would be enormous because the market is so small. And that flow is starting to happen. Retail investors are buying silver coins and bars at record levels. Mints around the world are struggling to keep up with demand. Premiums over spot price have been elevated for months because physical metal is tight. But it's not just retail. Institutional investors are starting to pay attention. Silver ETFs have seen significant inflows. Hedge funds are building positions. Family offices are allocating to precious metals as a hedge against monetary instability. The smart money understands what's coming. They're looking at the same data we're looking at. The supply deficits, the industrial demand growth, the monetary expansion, the geopolitical tensions, and they're positioning accordingly. Here's another piece of the puzzle that's often overlooked. Silver mining is becoming more difficult and expensive. The easy deposits have been found and exploited. New discoveries are rare. And even when new deposits are found, it takes years to bring a mine into production. The average silver mine takes 7 to 10 years from discovery to first production. That means even if companies started aggressively exploring for silver today, we wouldn't see meaningful new supply until the early 2030s. And that's assuming they find economically viable deposits, get the permits, secure the financing, and build the infrastructure. Meanwhile, demand is growing right now. Solar installations are happening right now. EV production is ramping right now. 5G build-outs are happening right now. The supply response can't keep pace with the demand growth. Some people point to recycling as a potential source of supply. And yes, silver can be recycled from electronics and other products. But the economics of silver recycling are challenging. Silver is often used in such small quantities in individual products that it's not economically viable to recover it. You'd spend more money extracting the silver than the silver is worth. That's very different from gold, where recycling is a major source of supply, because gold is used in larger quantities and is easier to recover. Silver's industrial applications make recycling much more difficult. So we're stuck with this situation where supply is constrained, demand is growing, and there's no easy fix. The only variable that can adjust is price. And that's exactly what we're seeing happen right now. The breakout we're witnessing isn't just a technical event. It's the market's way of signaling that the old price equilibrium is broken. Silver was too cheap relative to its supply and demand fundamentals. The market is now in the process of discovering what the new equilibrium price should be. And based on the patterns we're seeing, based on the historical precedents, based on the fundamental drivers, that new equilibrium is significantly higher than where we are today. Let me walk you through what the technical analysts are saying. The cup and handle pattern that just completed has a measured move target that projects prices well into triple digits. Some technicians are calling for $150 per ounce. Others are even more bullish. Now, I'm not here to make specific price predictions. Nobody knows exactly where silver will top out in this cycle. But what I can tell you is that the setup is extraordinarily bullish, and the risk-reward is heavily skewed to the upside. Think about it from a risk perspective. If you buy silver at $64 and it goes back down to $50, you lose about 20%. That's your downside risk. But if silver goes to $100, you make 56%. If it goes to $150, you more than double your money. If it goes to $200, you triple your money. The asymmetry is compelling. And that's before we even consider the tail risk scenarios where silver could go much higher if we see a real monetary crisis or a genuine short squeeze in the paper markets. There's another angle to this that's worth considering. Silver is often called the poor man's gold. It's more accessible to average investors because the per-ounce price is lower. You can buy a silver coin for $64. A gold coin costs you over $2,700. That accessibility means silver has the potential to capture a much broader base of retail demand. When people get nervous about the economy, about inflation, about the stability of the financial system, they can afford to buy silver. They can take physical possession of it. They can hold it in their hands. That psychological element shouldn't be underestimated. In times of uncertainty, people want tangible assets. They want something real that can't be printed or debased. Silver provides that at a price point that's accessible to the masses. And we're living in uncertain times. Inflation is still elevated despite central banks' best efforts to control it. Geopolitical tensions are running high. The global monetary system is in flux. Countries are exploring alternatives to the dollar. Digital currencies are being developed. The financial landscape is shifting in ways we haven't seen in generations. In that environment, precious metals become more than just investments. They become insurance. They become a store of value that transcends political borders and monetary regimes. They become a way to preserve purchasing power when everything else is uncertain. Silver, with its dual nature as both a monetary metal and an industrial metal, sits at the intersection of these trends. It benefits from the flight to safety that drives precious metals demand. And it benefits from the technological transformation that's driving industrial demand. That's a powerful combination. And it's why this breakout is so significant. It's not just about the price chart. It's about the fundamental forces that are reshaping the global economy and the role that silver plays in that transformation. Let me give you one more piece of context. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been working on alternatives to the dollar-dominated financial system. They've been accumulating gold. They've been developing payment systems that bypass Western financial infrastructure. They've been talking about commodity-backed currencies. If we move toward a monetary system where commodities play a larger role, where currencies are backed by real assets rather than just government promises, silver becomes incredibly important. It's more practical than gold for smaller transactions. It's more abundant. It's more affordable. It could play a crucial role in a reformed monetary system. Now, I'm not saying that's definitely going to happen. But the fact that it's even being discussed, the fact that major economies are exploring these alternatives, tells you something about where we are in the monetary cycle. The old system is being questioned. New arrangements are being considered. And in that environment, precious metals become more valuable. Here's what I want you to understand. This silver breakout isn't happening in isolation. It's part of a broader shift in the global financial system. It's connected to everything else that's happening. The inflation, the debt, the geopolitical tensions, the technological transformation, the monetary experimentation. Silver is breaking out because the world is changing. And in that changing world, silver's unique properties, its conductivity, its antibacterial qualities, its monetary history, its industrial applications, make it indispensable. The chains that held silver down for decades were artificial. They were the result of market manipulation, paper trading, and a financial system that favored fiat currencies over hard assets. Those chains are breaking. The fundamentals are overwhelming the manipulation. The physical market is asserting itself over the paper market. And once silver breaks free completely, once the full force of supply and demand dynamics takes over, the price discovery process could be explosive. We're already seeing the early stages of that. The 120% gain this year is just the beginning. Retail traders are betting on silver to be the top-performing metal again next year. Over 50% of them expect silver to repeat its performance. And they might be right. The momentum is building. The fundamentals are strengthening. The technical picture is bullish. But here's the thing. Most people will wait until silver is at $100 or $150 before they pay attention. They'll wait until it's on the front page of every financial publication. They'll wait until their neighbor is talking about it at a barbecue. And by then, the easy money will have been made. The opportunity is right now. Right now, while silver is breaking out but before the mainstream catches on. Right now, while the supply deficits are building but before the real shortage hits. Right now, while the technical pattern is confirming but before the parabolic move begins. This is what generational opportunities look like. They don't come with flashing lights and guarantees. They come with uncertainty and skepticism. They come when most people are still doubting. They come when the fundamentals are screaming, but the crowd isn't listening yet. Silver just broke out of its chains. The historic run is beginning. The question isn't whether silver is going higher. The fundamentals and technicals both say it is. The question is whether you're going to position yourself to benefit from it, or whether you're going to watch from the sidelines and wish you had acted when you had the chance. The metal that's been suppressed for decades is finally breaking free. The industrial demand that's been building for years is overwhelming the available supply. The monetary instability that's been growing is driving safe haven demand. And the technical breakout that just occurred is confirming what the fundamentals have been saying all along. This is the beginning of something big, something historic, something that could reshape portfolios and create wealth for those who understand what's happening and act accordingly. Silver has broken out of its chains. The question is, what are you going to do about it?